Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Ho, 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 will stocks go? Into the new year, we're going to have a happy new year and a great Christmas with a Santa Claus rally. Hi, stock nerds. I'm Texas Claus, Santa's first cousin or second cousin, twice removed. Everyone thinks Santa still delivers all the toys like he used to centuries ago, but actually with the population growth, he farms it out, kind of like Amazon drivers or DoorDash, right? But he keeps it in the extended family. He's a big family man. I think he must be Catholic because he's got a huge extended family. And like I said, I'm his second cousin, once removed, 2 generations below, or maybe that's once removed. I can never remember. My beautiful wife, AK, always remembers and keeps it straight because she's from Northeast Texas, tri-state. She understands they follow all that cousinry up there. And oh, bless your heart. Anyway, I'm down in the hill country. It's down there. It's actually getting much chillier. I actually had to wear my vest. Normally, I go out just like this in my short sleeve Santa Beach shirt, but it's got a little cold here, but that'll pass. It'll be 80 in another few days again. Anyway, so I deliver for Santa all the way from the coastal bend to the Panhandle to the Big Bend National Park, clear out in West Texas, where they have some snowy mountains. But the market seems a little shaky, and the Fed seemed to kind of throw a little curveball at it, kind of talking confusing. They dropped rates, and then are we going to get a Santa rally or not? Market's been okay, but it's been kind of choppy lately. And so with that, we're going to go straight to the team, and we're going to hear what Obi-Don Kenobi has to say. And by the way, before I forget, there's going to be no podcast next week, the week of New Year's, because we're going to let the team have a break. And so with that, Don, what does the market tell us?
The market tells us that just when you think that you've got your mind made up about something, it's going to throw you a curveball, get you to change to get in sync with it, and then it's going to throw you a knuckleball to make all the conclusions that you came to after the recent change get thrown out and go with the latest thing that it's throwing at you. And Dan, I'm just going to bring up this 60-minute chart of the S&P 500 that we've been watching for weeks now. It started off with a tight range going into Fed Day. Fed Day was last Wednesday. It was on the 10th. And we were basically talking about this tight range with 6,800 as the floor, 6,895 as the ceiling. And on the 10th, the initial positive reaction to the Fed was to break out of that tight range. But overnight, we had a hard sell-off. So this would have been going into Thursday the 11th, but finished well off the overnight lows. In fact, we held 6,800 overnight, rallied on that Thursday, and that kind of gave you the feeling that we're in pretty good shape now. And then Friday came, and we had a very harsh sell-off all the way back down to that 6,800 level again. But that held. This takes us into this week. On the 15th, 6,800 still holding. But Monday night into Tuesday, we broke below that 6,800 level. Tuesday night into Wednesday, we had a very hard break below that 6,800 level, which led to us not only getting stopped out on a bunch of our positions, but getting a bit more defensive on our index exposure, because we have different criteria for how exposed we are on the indexes depending on where the market is relative to the 21, 50, and 200-day moving averages, with a couple of other rules thrown in. So this brings us to Thursday. We had a gap up because CPI came out, and there's a lot of people saying that the CPI numbers were cooked. They were 2-month numbers. They were smoothed. Because a month was missed in there, there were some odd assumptions that were made. But the bottom line is we rallied. We gapped up, we rallied, we held the rally, but could not quite get back above that 6,800 level, meaning that it had flipped from support of this range now into resistance when we're trying to get back above it. You can see we failed here on the 16th. We failed again on the 17th. So just when you think that 6,800 has flipped to resistance, this morning we get a mild gap up, and the market has shown pretty good strength since then, holding that 6,800 level. The key is, are we going to hold that level into the end of the day Friday? It's 11:50 a.m. Eastern time right now. Are we going to hold that? And then what will happen next week as we enter a traditionally very bullish Santa rally seasonality aspect to the market? So put that range aside. Let's go back to the moving averages here on the S&P. There's a 1-day break of the 50-day moving average, which led us to get a little bit more defensive. That was Wednesday. Thursday, the green line, the 21-day moving average, could not get through that, but we did hold the 50-day moving average. So that's sort of a half of a check in the bulls column for holding the 50-day, a check in the bears column for not getting back above the 21-day. But today, with the gap up and the fact that we're holding, we're back above the 21-day moving average. And this is when the market does its best work, when it's above the 50-day, the 21-day, and the short-term 8-day exponential moving average, which is now hooking back higher. So this is bullish from an index standpoint, and more so, let's go to the NASDAQ 100. Yes, Tuesday, Wednesday, and Thursday, the NASDAQ 100, the QQQ, was unable to get back above the 21 and the 50-day moving average. But today, we are reclaiming those two levels. That's something very critical that we'll be watching into the close today, because the NASDAQ 100 has been lagging the equal weight. That causes the S&P 500 to lag relative to the equal weight version of the S&P 500, that being the ticker RSP. And this looks fantastic. This never had any breakdowns at all, never even pierced the 21-day moving average, had a breakout from this flat base, pulled back to the pivot a little bit, but showing superior relative strength going all the way back to the end of October. So equal weight has outperformed the market cap weighted version of the S&P 500 going back to the end of October, and that's strictly because of the underperformance of the NASDAQ 100. These three charts they just have a flat out positive correlation or inverse correlation depending on what you look at. But when the Qs are underperforming the S&P, the RSP is going to outperform the S&P. When the Qs are outperforming the S&P 500, the equal weight is going to underperform. So we saw a lot of money flowing out of growth type names the NASDAQ is very tech heavy. A lot of tech names, a lot of AI names got really taken apart. But we are coming into the Santa Claus rally. The market seeks to confuse the masses. The masses, if you just shift that M to the end of THE, it spells something differently that I'm not going to say on the air. But that's what it makes out of you very often, because of all the curveballs and knuckleballs that can be thrown your way. So the bottom line to all of this, I know I said a whole heck of a lot, and it could be confusing, but it sticks with that 6,800 level on the S&P 500. Do we hold it going into Christmas week next week and into the end of the year? And then what will tech stocks start doing? Let's take a look at the two main ETFs that we use for proxies for growth, and that's the FFTY, the IBD 50. This had a bear market sell-off in a matter of 3 weeks, trying to recover, and it's regaining the 21-day moving average right now, well below the 50-day moving average. So we're looking for some relative strength to come back into FFTY, as well as ARKK. That's the second one that we watched, that pulled back from 92 to 70. That's a bear market there as well. Nobody talking about a bear market in any way, shape, or form on the news headlines, because they don't check under the hood the way we do about what's actually going on with the leading stocks in the market. But you can see ARKK battling at its 21-day moving average, We want to see that get above that declining 50-day moving average again. Those two things happen. That'll give us more confidence to go back into some of the tech names that we got stopped out of over the last 2 weeks that had been holding up very well, but really took it on the chin Wednesday with that last ditch shakeout. But then we had Micron earnings come out Wednesday night into Thursday. Micron was a leading stock going back to its breakout in September. Went from 128 all the way up to 250. It had a double. It had a very hard shakeout that started with this this AI pullback. That was at the end of November. Last week, it had another one. Massive upgrade, or they beat earnings like across the board and sales and upped guidance. So this is going to kind of be a proxy for individual names for what you're looking at. And right now, this is holding up very well. It gapped up on Thursday, closed near the bottom of its range, but it made a higher high relative to that range today. That's called a day two higher high. That's historically very bullish. So now this gives you a good level to trade Micron against. The 8-day moving average is coming up to the bottom of that gap day. And this is one of the key stocks that we're keeping an eye on for overall health of tech names. There are a couple of others that we're keeping a close eye on. Palantir held up extremely well. You can see it breaking out of a cup and handle today, but volume is a bit on the light side, just barely above average. Today is also quad witching, which has to do with options and futures expiration, and you tend to see some shenanigans into the close, both with individual names and with the indexes. So we're on guard about that. But in addition to Micron and Palantir, there are several stocks that had leadership characteristics that just pulled back. Here's Light, has a 10% daily range, so be wary of that when you're position sizing. But that just held its 21-day moving average. The best of the best held their 21. We had some get stopped out on our 21-day moving average, breaking below that. But I believe that 16 or 17 of the 21 over 21 list going into this week has held their 21-day moving average. So that's a plus sign too. We're always weighing the evidence, the positives and the negatives. But MU as the bellwether, you can keep an eye on that. The NASDAQ 100, the QQQ, you want to see it hold above those key moving averages, 21 and 50-day. And we want to see the S&P 500 hold that 6,800 level, as well as its 21-day moving average, which is right around that 6,800 level. So, Dan, what do you got? What questions, what clarifications do you have on that?
That actually was very succinct and pretty technical. I think that's Santa calling. Just tell him I'll call him back, Zach. So, but let me put my interpreter on and kind of basically in very, very simplistic layman's terms, it sounds like you're saying the market has been pretty choppy as of recently, but just right now, just today, this morning, and maybe a little bit toward the close yesterday, it seems like the probabilities are looking better for a Santa Claus rally. And it's starting to look a little stronger. You're now becoming a little bit more bullish, or the market's telling you it wants to be more bullish versus bearish. You unwound that small hedge yesterday, right?
Yes.
Okay.
Yes, very small, and added back to some index exposure with the break back above the 50 and the 21-day moving average. And the good thing about it is it's a very tight stop, because we should hold 6,800, and then right below 6,800 is the 50-day moving average, right around 67, 67.
Right.
So we've got pretty clear levels to trade against. You could say that the market's been the good, the bad, and the ugly being AI growth type names. The bad being the NASDAQ 100, the way it had been lagging, which also dragged down the S&P 500 because of the heavy weights. Right. The good being the RSP, the equal weighted S&P 500. So what we're looking for is some underperformance on the RSP that will be caused by outperformance on the NASDAQ 100. Right. And the beneficiary of that will be the market cap weighted S&P 500, which we play through SPYM. because they don't hold your. In fact, SPY went ex-div today, meaning they pay out their dividend at the second to last week of every quarter. If you own SPY, you're not going to get that money until the end of January. But if you own SPYM, IVV, or VOO, those are the main S&P 500 ETFs, you're going to get it within a couple of days. That's why we never own SPY, and we do own SPYM.
You're saying
which
SPY
has
is kiting your money? That's
SPY
horrible.
is kiting our money.
That's
They're
horrible.
holding it. I don't know what they're doing with it, but I'm sure it's not it's benefiting them. It's not benefiting the holders. But we use the SPY to track price because
Sure.
it's the most liquid.
It's the
but
very
that is
first
something
ETF,
that-
folks. I think in
yeah, that's
1994
something
they
in the
rolled it out.
fine.
Yeah.
That's something in the fine print that on the SPY that not a lot of people are aware of. But
Yeah.
we try.
And
to
it's more
educate-
expensive. The
educate the
fee
masses.
structure is a lot more than these other ones.
It is slightly
Yeah.
more.
Yeah.
SPYM is the cheapest. IVV and VOO are very inexpensive. Also, it is, chalk one up to John Bogle for getting the S&P 500 and index investing for a very low price. However, that is still the least expensive way to lose 30% or more in a bear market. So
Yes, said another
that's
way.
why
Don used to always say, owning a Vanguard ETF is a cheap way to lose money fast in a bear
Yes.
market. Look, in a good market, if you're just wanting some passive exposure, it's good to add on. You just can't buy and hold. Excuse me.
Dan, I also want to point out, we like to point out the differences between Revere and other advisors. We had somebody transfer in this past week from another advisor, and it never ceases to amaze me the garbage stocks that they will keep their clients in. Let's take a look at some of these really quickly. Now, the market is at near all-time highs. This means that you would want your stock to be near an all-time high. It means don't hold a stock simply because of the ticker unless you want to lose money if that stock falls out of favor. Let's take a look at some of the garbage that was in this portfolio that transferred in. And this is why people leave their advisors and come to Revere. We talk about our process constantly. We want to be in leaders, not laggards in a bull market, plain and simple. This is the example of buying rotten fruits and vegetables to maintain a balanced diet. Why would you do that to yourself? Why would you wear a winter coat to the beach or go dressed or go out in a rainstorm without an umbrella? Netflix, everybody knows Netflix, but Netflix is 35% off of its highs, well below the 200-day moving average, showing no strength at all. Uber, another great name, below its 200-day moving average, 20% off highs. Kimberly-Clark, I mean, how can you mess up cosmetics and personal care? Well, they're 40% off their highs under the 200-day moving average. Public storage sounds like a great thing to be in. You see self-storage all over the place. This stock has gone nowhere. It's under the 200-day moving average. CubeSmart, same thing. Sounds like a natural. No, it's under the 200-day moving average, and 80% of stocks in the market have outperformed it over the last year. Home Depot, great name, not a great stock. 30% off of its recent highs just a few months ago. Booz Allen, they do consulting. What is especially for the government? What's the government doing? They're cutting the hell out of government contractors to save money. Why would you own a stock like this? Under the 200-day moving average, 40% off of its highs. W.R. Berkley, insurance. You can't mess up insurance, can you? Well, you can if you're W.R. Berkley, because they're under the 200-day moving average. Do you think anybody that was running this guy's money even took a look at a chart of W.R. Berkley and started to ask themselves, why did this stock just drop 20% in the course of a week, and should I do something for my client? Hell no, they don't give a crap. CF Industries, under the 200-day moving average. Chevron, everybody knows the name, under the 200-day moving average. VRSK, analytics, research, sounds like a great business to be in. Well, the stock is 40% off of its recent highs. Are you understanding what I'm getting at here, Dan? This is absolutely ridiculous, the malpractice that some advisors do for their clients by putting them in absolute garbage without concern for what it's doing to the overall portfolio. On the other hand, I would like to thank them very much because they provide a steady source of clients.
A big Merry
Revere Asset
Christmas to all the buy and hold advisors for
Yep.
sending us your clients. That's hysterical.
Yep. And these aren't in some sense this is worse. The typical pie chart just uses ETFs and mutual funds for their broad allocation to the S&P 500. This is actually worse than doing that because they're picking like 40 to 100 different names, but not caring about, they're diversified into garbage, rotten fruits and vegetables, not caring about what the chart or the business deterioration. Booz Allen is a glaring example. You shouldn't be within 100 feet of a stock like that, who makes their money based on being a consultant for government jobs, and all the government is doing is cutting jobs. I mean,
Yep.
a blind man can see that that's the wrong thing to be doing. But once again, thank you very much. To anybody listen out there, if you've got money in stocks like this, ask your advisor why they're holding garbage and see what their response is.
Ask
The
them what their
response will
sell
be that they
discipline
really
is.
don't. Yeah, they don't have one.
Detailed sell
Plain and
discipline.
simple.
Yep.
Plain and simple. All right. Was I didn't want to be
that's
too
it.
mean,
I think
Dan,
we beat them
but-
up, and that's pretty good. We don't need to dogpile anymore.
Okay.
Unless
All
you
right.
want
So
to.
they can yell at me and not at you this week for being mean to other advisors. But
Yep. I had a client come over Fisher, and they just had 50 stocks at 2% each. They just let it ride, and it was during 2022 inflation bear, and she was down 25. She was just tracking the S&P. I said, if you're going to do that, just go buy the S&P ETF. Be done with it. You don't even have to pay them. But anyway.
All right. So let's go to the fellas now. And Connor's going to revisit the space/satellite stocks. A lot of talk now about, because of how expensive it is to cool data centers and build them. People are talking about data centers in space, whether you can believe it or not. You don't need to cool down something that is in the freezing depths of space. Obviously, there are other hurdles to overcome, but this is a theme that is getting a lot of traction. And there's three main stocks in here, and Connor's going to talk about them. Take it away, Connor.
Yep. Wanted to circle back from last week's presentation. And last week on the podcast, I talked about space stocks and the potential catalysts, SpaceX IPO in 2026, government defense spend, the global TAM rising and getting kind of a re-rating with the space and AI and data centers in space. And just yesterday, Trump signed an executive order committing the United States to return to the moon by 2028 and build a lunar outpost by 2030 and prepare for the journey to Mars. So this was another catalyst yesterday for this whole group. And you can see that chart of Rocket Lab, it's reacting extremely strong today. And just some highlights from that executive order. They talked about in it, they want to make U.S. space superiority a core national priority, and then they also want to target $50 billion in new space investments by 2028, which is pretty huge. And the market is clearly reacting to that quite well. Don's got Rocket Lab on the screen here today, and we own this one in TurboTax, and you can see it's up over 15% on the day and clearing that range high. So again, when news comes out, this executive order isn't directly related to Rocket Lab, but again, many things in it can indirectly help Rocket Lab. And the market clearly likes that. And when you see good news and the stock reacts positively to good news, that's a good sign. So this one's clearing out those highs, those recent highs today, and then really the next level is those highs on the left from earlier this year. But this is kind of exactly what you want to see, how names react on a catalyst, and this is definitely one of the hottest themes in the market right now. And even when the market pulled back, I mean, this is a volatile stock, so this did pull back pretty aggressively, but it just retested the top of the base, had a couple tight days, and then started to break out like it is today. So that's Rocket Lab. To me, this is the leader in the space right now. And then the next name is Planet Labs. This is another name owned in the TurboTax portfolio, and it had that very strong earnings gap I talked about it last week. That's where we bought it on the gap. It was a classic beat and raise quarter, and their inflection point towards growing profitable. And this one pulled back with the market, which is quite normal. And then, with that catalyst today and with the market bouncing, this one's, springing right back into the highs, almost up 13%. So that one's acting quite well. And then the last one is ASTS. This is like the satellite play of the group. And this chart is a bit more choppy, less extended, but reclaiming all the moving averages here today and still has a good look, all things considered. So see if this one can continue, but back above the 50-day moving average is a good sign. And overall, this executive order is just showing to be really positive for the whole group. As you can see, all these stocks are reacting extremely well to this news from yesterday. So continues to be a focus, really hot theme, tons of catalysts moving forward. So these are 3 names to watch, and they're up quite a bit today. Probably wouldn't be the best spot to initiate a new position, but again, if this theme narrative is going to be real, these will have plenty of upside and they'll offer opportunities along the way. And like in past episodes we've done, utilizing, different entry tactics like using the 60-minute stochastic, looking for oversold readings there. That can be a good way to get on board some of these stocks. So see how this fares in the coming weeks, but for now, pretty good reaction off the executive order.
Good stuff, Connor. Sometimes 1 + 1 does equal 2 in the market. On the other hand, MSOS, marijuana ETF, signed the legislation to change the schedule from Schedule 1 to Schedule 3. Sell the news. Yesterday it was down. Nice move up, however, down 27%. Unbelievable. All right. That was quite a tangent there, going from space to marijuana, but either way, somebody's high, right? Ted's got 3 tickers that we own across the board in all of our portfolios. They happen to be the first stock he's going to talk about is one of 2 that held up remarkably well. 2 very clear standouts during this week's pullback. I'm showing Lily right now. That's the second one. He's going to talk about the first one, that being Tesla. Take it away, Ted.
Yep, like Connor, just doing a follow-up on the names I talked about on the last show last week. First one's Tesla, like Don said. And we're looking at this last week when it was starting to form that handle, a consolidation right there, right against the 821 and 50-day moving averages. And it's really made a nice move. We saw it close at all-time highs, a daily close and all-time highs a few days ago. And now we're just consolidating once again under that all-time high level. And you can see the volume drying up sequentially. And today looks like a really dry day too. So that's really constructive action. The 8 EMAs catching up as well. And we'd like to see the 21 catch up to the lows of that consolidation around that 470 level. And what we're eyeing is taking out all-time highs definitively and the 500 level. And from the chart, when we're looking at the weekly and monthly, it's in a huge weekly and monthly base, multi-year range. And I've just talked about it so many times on the podcast now. Tesla loves to go sideways for multiple years, and then there's a catalyst that sends it up for a 1 to 2 year momentum run. The previous 2 were on better than expected car deliveries on earnings reports. This time around, it's less on the actual fundamentals of the company, like a traditional fundamentals where we talk about earnings and sales, but it's on the anticipation of a new paradigm pretty much in AI, robotics, and robotaxis. They're humanoid robots and they're robotaxis. And we're on track here for an all-time high monthly close and weekly close. So we'll see if we get it by the end of today. And this is one we're definitely excited about. It's showing tremendous relative strength, like Don said, in this recent market pullback. And that is how we identified the leaders. You can see the RS line made a new higher high relative to that base period in September and October. But one thing we do want to see is we want to see the RS line break above last year's highs as well. Right now, even though we made a price high, the RS line has not made a new high relative to itself. If you can show that as well, Don. Might be easier on a weekly chart since the data is blocking it. You can see, RS line
Close, but
hasn't
not
quite
quite.
broken. Yeah, not quite yet. So we would love to see that confirm as well with new all-time highs in price.
All right.
The next name, we're all in across the board, or next two names, it's just gold and gold miners. And I covered kind of the macro theme or fundamental theme with this. There could be so many different reasons. And to us, maybe one of the main reasons is just a mistrust in government and as well as fiscal policy, printing trillions of dollars, and people just want to own hard assets. And gold is one of the longest standing hard assets of human history. This one is consolidating right at another all-time highs. In gold futures, which is the spot gold price, it's about 4,400 is the all-time high. On this GLD, it's about that 400 level, 403 level. And just acting really well right now. Again, like Tesla, we'd love to see the relative strength line break that last high it made along with price. And this one has been acting really well. It's wedging a little bit into the breakout level, so maybe it could be prone to one last shakeout. But regardless, gold's acting extraordinarily well. Similarly with gold miners, GDX, this is really just a typical, so many different entry points in this. You started off with that lower entry point around 72.5-ish when it reclaimed the 821 and 50 day. I believe that's where we took a starter. And then it gave another add point in this recent higher handle in that 80-ish range, 81-ish range. And now you can top off your position in this higher handle. So it's really just stair-stepped quite nicely. And these types of basing patterns, climbing up the right side so constructively, where resistance turns into where previous resistance turns into support, really just provide nice places to pyramid. And it's one of my favorite when a stock acts like this. And we own NUGT just for a little more juice, which is the 2x ETF. And you can see this one, the RS line is confirming a new relative strength high relative to that previous high. So that's definitely a really good sign. So that's just one theme and then one individual name. I guess could potentially be part of a larger theme, which is that push into robotics that hasn't fully reflected yet in the market. So robotics is definitely early, as we haven't seen too many names or publicly traded names reflect this push for mass production of robots.
All right. Good stuff, Ted. Let's go from precious metals to hard metals. Drop them on your foot. They're going to leave a mark. Todd, take it away.
Great. Today, we're going to talk about an industrial metal, copper. And the first chart I want Don to bring up is actually CPER. This is the actual commodity itself. Sorry about the audible, Don, but this is an interesting chart once it comes up here. So copper is an industrial metal, and we are seeing a pickup in the industrial complex through names like General Motors, which is recently broken out, Ford, Tesla that Ted just spoke about, as well as Rivian. So the entire automotive complex is breaking out right now. Silver is actually more of an industrial metal than it is a precious metal, and a lot of its demand is driven by industrial demand. But there is no more of an indicator than copper in that. And this is the copper ETF. And it made a new high back in July when Trump put massive tariffs on copper imports into the US. It then collapsed after that when Trump backed off and said that any finished goods would not be tariffed. And that basically means every copper product coming into the US, which is most everything, wouldn't be tariffed. So the commodity took a hit. Well, now we're starting to rise back up through the right side of that. To give you an idea, the copper commodity right now is around $5.51 per pound. It was at 585 at those highs. So we're getting close to those all-time highs. And the miners is how we're going to look at this. And the COPX is the miner ETF, which is breaking out. And we'll start with that, and then we're going to talk about two names. But this broke out of a nice flat base, and it's accelerating. And the miners are leading the commodity price, and one of the top global miners in the world is Freeport-McMoRan, FCX, which has got a massive base developing. And we're starting to come through the right side highs going back to last year. And if, Don, if you could pull up a weekly chart to show just how long this base is. This goes back to 2024, and then prior to that, it went sideways for a long period of time. So we're starting to see Freeport-McMoRan potentially break out of this massive base that it's in. The other stock that we're going to talk about is TECK. And Tech Resources merged on 9/9. So on September 9th, on that gap up back in September, that was a merger with Anglo American, which is also one of the world's largest copper producers. This was a big value add. The two companies merged to improve their position in copper. Gapped open, went into this long basing pattern, and is now close to breaking through those all-time highs. The leader in the group is Southern Copper also, which is basically the strongest name of the group, and that's been breaking out. But these are two names that are in tight bases right now that are currently close to hitting buy points or at buy points, and Southern Copper has been the leader in this group. So again, we've seen silver lead now, the precious metals, because of their industrial slant. Now we're seeing copper pick up and break out. So this is another area in the market outside of technology that we're taking a look at.
All right, commodities. If you don't trust fiat currency, and a lot of people don't, this is the place to put your money. Let's go back and do a quick check on the S&P 500. Looking good. Near highs of the day, clearing that 21-day moving average and holding it. All pullbacks. Let's go to SPYM, which is our preferred ETF. Bring up a 5-minute chart very quickly, and you can see any attempted pullback has been bought today. Pullback bought, combination of higher lows and higher highs, my friends. That is what an uptrend is. Higher highs, higher lows. And this is doing what we want it to do, plain and simple. We don't argue with the market. Dan, that's it from the tech side. Let's send it back to you.
Well, thank you, Don. Folks, listen.
Dan, Did you change your hat?
Hat? What hat?
Yeah.
Actually, that's magic. That's the reindeer.
That's what that is.
It's not Santa's reindeer feed. Down here we do Axis and mule deer from South Texas, and we mix it together. And so and it just magically this outfit just comes on me when it's the week of Christmas. It just happens, and my hat rotates around. But anyway, folks, listen. If you like what you heard, please tell a friend, tell a neighbor, just send them to revereasset.com. We're the most transparent advisor, not just in the United States, in the world that I'm aware of, because we go on a video every single night for about 10, 15 minutes and tell you exactly what we think about the market, short-term, mid-term, long-term, and what we're actually doing in our client portfolios as well as our own, because Don and my family's money are in these exact same portfolios at the exact same price and timestamp. Your tracking will be just like ours, except we're gross and you're net, because I don't charge my wife a fee. She'd kill me. Anyway, folks, have a very Merry Christmas, Happy Hanukkah, whatever you choose to celebrate. Drive safe, be careful. Give some people a break. It's getting crowded out there. And by the way, you can always call us old school. at 855 Real Wealth. Merry Christmas, Happy New Year, and we'll talk to you next year on your money. Not their money, not Wall Street's money, your money.
She might kill you anyway based on those outfits. But it's not how much you make in the market, it's how much you can keep.